Hey guys, it's that Dividend guy coming at you with another dividend investing video. So I did make a couple of changes to the portfolio and I wanted to address them now. So I did sell out of Disney, which that took a lot out of me. I love Disney stock. It is one of my personal favorites. Um, and it will be back in the portfolio once that dividend gets reinstated, if it ever does. I might make an exception for Disney. I wanted to keep it at 25 stocks, but I really am considering putting some growth into the portfolio with a few pretty big names, pretty popular names. So I have no issue with adding growth to the portfolio. And if I did, Disney would definitely be one of those stocks. But I'm updating you because I wanted to show you the stock that I replaced Disney with. So the reason I got rid of Disney was because they cut their dividend and that no longer offered me passive income. So that's the whole goal, is to make the stocks with dividends, because I don't like appreciation. I prefer to be paid passively. So and be able to reapply that cash in other places. So since Disney cut the dividend, I decided to buy a stock that I've held before, Walgreens. So the reason that I sold Walgreens was because I didn't think the dividend was that attractive at the time, and I was worried about being exposed to retail because I already own Target. So I already have a pretty decent position. It's only 10 shares. But I didn't want to be too exposed to the retail side of things. But I'm comfortable holding Walgreens. I've done a lot more research than I originally did. And this obviously will help. Um, so this is three ways that Walgreens is proving to be a pandemic-proof stock. Now, these were not reasons that I bought Walgreens. There is the reason that I bought it is in here, though. So let's jump right into it. So the sales remain strong even amid the lockdown and in the UK. So Walgreens released third quarter results, and even with the challenges due to COVID-19, the company still squeaked out revenue growth at 34.3 billion. The company's top line wasn't a whole lot different from 34.59 billion at Walgreens that Walgreens reported the same quarter last year, but that increase looks much more impressive when you factor in the fact that the company's retail pharmacy segment was down more than 31% from a year ago. The company blames the disappointing results on COVID-19, as many of its Boots UK stores were closed during the quarter as the result of the lockdown. So this is really good, guys. So they squeaked out growth when a bunch of the stores were closed in places where the stores were closed. So if they can remain profitable, even a small amount like this, even with segments down, they're still profitable. That's phenomenal. So that makes me feel comfortable, because a lot of companies, guys, during this pandemic have cut dividends, have closed, haven't even been operable. Like, this has really put a dent in a lot of businesses. So the fact that there are some tried and true businesses that are strong enough to still post positive numbers at all during this really tells me that it's a strong business. And to be honest, a lot of those really like the dividend payers that have had consecutive dividend growth, that have found a way to keep pushing their dividend forward. A lot of those companies, guys, have increased dividends during this. So, like, just to drop some names, Procter and Gamble, I believe, did an increase. I know Altria did. I know Wells Fargo, or sorry, Wells Fargo cut it. Walgreens did as well. There were a couple more that I saw online that did. Realty Income did. Aristocrats and Kings tend to keep pushing, and even if they miss a quarter where they're supposed to boost the dividend and they do it a quarter later, that still counts. So it's crazy to me that they still pushed out a profit when they were down. So that's one really good reason, is the health of the business and the diversity of the business. So even though they're a retail chain, they were still processing and putting out prescriptions and making money that way. Even if the retail side of the store was closed, the pharmacy was still doing orders. So that's one thing that sets them apart, is that they're not just dependent on one thing. They're diversified enough that they can still make a profit in something like this. And the next reason is why I did buy the company. Given nearly 900 million reduction in the revenue, it was Walgreens that continued U.S. growth that helped the sales numbers stay positive in this quarter. Sales are up 3.2% in the retail pharmacy division, exactly, almost completely neglecting or negating the decline from the international pharmacy segment. Minor improvements in Walgreens wholesale segment helped give the company's top line an additional boost, which pushed it above the prior sales numbers. Walgreens recorded an adjusted profit and generated positive cash flow. So like I said, they made a profit and they had positive cash flow, which is really the positive cash flow is king for any company in my opinion, because they don't pay you dividends off of the profit that they make or the adjusted earnings or the EPS. They give you the money that you get is from the cash flow that they generate after everything is paid, after they pay off their debt, their expenses, pay their employees, all that. Cash flow is literally the money that they have just sitting there after they do everything for the business. So that's extra cash. And so what they decide to do with that cash is up to them. They either put it back into the business for investments. They can do acquisitions, stuff like that, or they can pay a dividend. So cash flow is king because that's what they pay you with as a dividend investor. So arguably more important than sales is the company's bottom line, and that looks to be strong. Although Walgreens adjusted net earnings declined by 46%, which is expected. Almost every company has had a loss here. Every company has had declines because they're not open. They can't be as profitable as they were when the pandemic hit because they have to close things. Like Disney closed cruise lines, they closed theme parks, retail closed their retail segments. Like restaurants closed. So nothing is going to be as profitable as it was. But they still came in with a positive $723 million. The company reported a net loss of $1.7 billion in the quarter, but that was primarily due to the impairment charges of the $2 billion related to Boots UK. So they still have positive cash flow, and that's the important part. After adjusted earnings can sometimes be closely reflected in the company's strength in the financial position because they account for the non-recurring items like impairment. They also are a better indicator of how the company did from a cash perspective because they can often factor the non-cash items. Overall, Walgreens generated $914 million in positive cash flow from the day-to-day operations activities. These are some impressive numbers given the company's higher supply chain costs and cleaning expenses due to COVID-19. Its financial strength and diversification are key reasons why Walgreens is able to keep paying and increasing the dividend payments, and this is why I bought the stock. The company raised its dividend for the 45th straight year. On July 8th, Walgreens declared that it would be raising its dividend yet again by a small 2.2%. Shareholders are now receiving quarterly dividend payments of $46.75, a share price of about $40, that the dividend yield is about 4.7%, well above the 2% investors can typically expect from the average S&P 500 stock. And see, this is why I choose individual stocks here. So I'm not going to go on a big rant about it, but let me explain. So if the S&P 500 only returns 2%, but it returns 8% annually as the dividend price goes up, you only passively get 2.2% by the dividend. See, so that's why I don't like doing the S&P 500. I would rather mirror the S&P 500 with individual stocks that pay me at a better rate than the S&P 500 overall index does. So if the index only pays me 2.2%, but I gain 6% in the way that the stock goes up and the appreciation of the stock, in my eyes, only make 2% because I can't do anything with that 6.6% that's tied up with gains of appreciation of the stock. I don't care about the stock appreciating. I really don't. It can appreciate a little bit because that shows a healthy business, but I want my revenue or my profit, my passive income, my wealth to be built through dividend investing. I want the dividends so I can reapply that. So if Walgreens pays me $30 in dividends and another company pays me 10, well, I can buy Walgreens stock if I feel like it's depreciated, but I can't do anything with that money if it's tied up in the stock. So that's just the way I choose to invest, but that's why I like to do it because that makes my cash liquid. I can apply it. I can throw it wherever I want to. But this is the 45th year that they've raised their dividends. So by the time I'm 31, they'll be a dividend king, which I'm excited about. This also marks the 45th year in a row that the company hiked its payouts as a dividend aristocrat. Walgreens continues to be one of the safest dividend growth stocks for long-term investors. Is the stock a buy? Which I hope it is because I bought it. Given the resilience amid the COVID-19 pandemic and how important the pharmacy retailer is providing to be to customers right now, it's hard to not like Walgreens as a long-term investment. Not only does it pay great dividends, but it's a healthcare stock. But the healthcare stock's also cheap, trading at just 10 times earnings and 1.4 times book value. So I was right in in my calculations, or pretty close there. Although Walgreens stock got a boost from its Q3 results, it's still down 31% this year. S&P's declined just 1, but with many stocks soaring at all-time highs to seen multiples, Walgreens looks like one of the better value buys still out there today. So keep in mind, guys, it's down 31% from highs. So not only are you, if not, I'm not saying you should buy, but this is why I did. So the stock is down. So let's say it's like $57 a share is the 52-week high, and it's at 40. So I have a $17 upside in the stock. Plus I get a dividend that's consecutively grown for 45 years. So I know the stock price is down, but that's due to COVID. I have upside in the stock, $17 on 6 shares. So I have over $120, nearly $120 of upside in the stock. Plus, I get a 46-cent dividend per share. So that's how I look at it. I think I made a great purchase, but it was hard to sell Disney. But I think Walgreens is going to generate more cash flow in the way that I prefer my wealth be given to me. So I'm a dividend growth investor. If a stock cuts the dividend, I cut the stock. So unless I look at Disney from a growth perspective, and then that's fine. But generally, my rule of thumb is if a company cuts its dividends, I cut the company. So I'm happy to be an owner of Walgreens. I did announce it on Instagram when I posted it. So if you guys follow me on Instagram, or if you don't, you should, so you get updates. I generally post there before I post a video. So feel free to follow me there on Instagram at that dividend guy, same handle as the channel. But with that, guys, I will wrap it up. Thank you so much for watching. Hit the like button. If you like Walgreens or Disney, tell me why. Do you think I made a mistake selling Disney? I kind of think I did, but I don't mind selling it. I put the money where it can generate income for me in the way that I want it to. So thank you guys so much for watching. Remember to hit the subscribe button, and when you do, hit the bell notification so you don't miss any updates. I post videos every single Monday through Friday, every weekday on my portfolio, and I do news videos or portfolio changes, dividend hikes, dividend payments, stuff like that on the channel. Kind of sprinkle that out throughout the week. So thank you guys so much for watching, and I'll see you guys in the next video. Thank you so much. I'll see you then.